Good afternoon, everybody. My name is Mark, the stock market jobber, and I'm here to try to teach you a little bit about trading and how Wall Street really works. And I have a good background for this. I was in the institutional trading world for longer than I care to remember, but it was just over 2 decades. I traded directly for Mario Gabelli and Steve Cohen, who are each two of the greatest money managers in history, so I was very fortunate with that. And then I went on to be the head of trading at a couple different money managers where I oversaw the strategies of various different styles. I mean, I've overseen the trading of hedge funds, mutual funds, standard institutional money management. I was actually a market maker for 2 years. So when it comes to trading, there's really not too much I haven't seen. So now what I want to do is try to teach people about how trading is, or what it takes to be a successful trader, and what really happens on Wall Street, and kind of dispel some of this myth there that's going around. And there's a lot of myths out there about since I've been talking to retail traders over the past year or so, I mean, there's just so many myths and misconceptions about what really goes on the Wall Street and what traders really look at and so forth and so on. But anyway, I just want to do our daily SPY outlook here, and please check back because we cover this every day. And please subscribe to our community here on the YouTube page, and please check out our website, stockmarketjobber.com. And all right, let me talk about SPY. So what is SPY? SPY is the S&P 500 ETF. That's the symbol. It's the Spider S&P ETF. Spider is because this is run by Standard & Poor's. So it's a Standard & Poor's depository receipt. This is designed to track the S&P 500. People can't trade the index directly, but what retail traders can trade is the ETF that tracks it. In the institutional world, there's futures and so forth and so on, but this is for our intents and purposes, this is more than enough. Now, you can see we're up a little bit today, but we're still trading around this important 410 level. This was resistance back here, and it was resistance here. Some levels are more important than others in the markets. That's a really fundamental principle. In the institutional world, we don't worry about really, crazy things like Fibonacci and Gann theory and Elliott wave and harmonic charts. At least no one I ever traded with ever worried about that stuff. And I've traded with some of the best traders pretty much that are alive. I mean, I don't want to sound boastful, but Steve Cohen is probably could be the greatest trader in the history of Wall Street, and that's saying a lot. And Mario is could be one of the greatest long-term money managers or buy and hold investors or fundamental investors that there's been. But anyway, we're back within this range. We've been sticking around this 410 level, 411. We got up to like 415. We got down to like 408. But considering that we're talking about a security that's priced at $410, that is really, I mean, we're still there. We're right within this range. We're within a couple percent. Now, tomorrow we have the CPI coming out. So make sure you check back tomorrow because tomorrow could be the thing that makes us make a decisive break off of this. Or tomorrow could be, I should say, could be the time when we make a decisive break off of this. And that's because we have the CPI or the Consumer Price Index coming out tomorrow morning. Estimates, I believe, are 6.2. Now, the market has been trending, well, I should say it was trending higher until early February on this kind of narrative that the Federal Reserve is going to stop raising rates and start cutting rates. So here's the deal, right? If the CPI, the consumer, if the consumer price index, if it comes in higher than estimates, well, then that really kind of puts I don't know what the right word is, puts a knife or whatever, or, stick a fork in that theory or whatever. But if inflation is running hotter than people think, then there's no way the Fed's going to start cutting rates, and it would give more incentive for the Fed to keep raising rates. Higher rates are bad for markets, for stocks in general, and that's because there's two things going on. One is higher rates make companies less profitable. Big companies don't take money out of the cash register to pay their employees. They have what they call like lending agreements or lending arrangements or overnight agreements where they're borrowing money on the short term to have their day-to-day expenses paid. If interest rates go higher, that money costs more. So it takes the profit right off of the bottom line. The other thing too is if rates go higher, funds, the big funds that use leverage are going to borrow less money. They're going to use less leverage. So interest rates directly affect the market. So if we come in higher than estimates, and again, estimates I think are 6.2, and even if we do come in there, I mean, inflation is still high. It's coming down, but it's still high. But if we get above 6.2, there's a good chance the market heads south. If we get below it, then people will start to say, all right, well, the Fed really can stop raising rates or at least slow their rate hikes down, and that will be bullish for the market. So tomorrow is going to be an important day. So please make sure you check back. Please make sure you subscribe to our YouTube page here, Stock Market Jobber at, sorry, Stock Market Jobber. Well, if you're listening to me, you're probably on our YouTube page. Um, and check out our website, stockmarketjobber.com. And I will see you soon, everybody. Should be an interesting day tomorrow. Thanks, everyone.